Hey, what's up everyone? Welcome to the channel, where we break down the real wealth-building strategies that most people overlook. Today, we're diving deep into something that's bound to get you thinking. The wealth secrets investors don't want you to know. Now, I'm not talking about the regular save more, spend less tips. Nope. Today, we're getting into the nitty-gritty of wealth-building moves the ultra-wealthy know but rarely talk about openly. Think of these as the behind-the-scenes secrets things that can make a world of difference in building your financial future. Whether you're looking to secure your finances, diversify in smart ways, or make moves that set you apart from the crowd, this video has something for you. So grab a notebook, hit that subscribe button, and let's dive right into it. Let's kick things off with a simple truth that most people ignore: the hidden costs lurking behind popular investments. Ever heard of silent fees? These are charges you don't immediately see, but that, over time, silently eat away at your returns. Take mutual funds, for example. They seem like a straightforward, low-risk choice, right? But buried within are management fees, performance fees, administrative fees, and even soft costs like marketing fees. And if you're not careful, these fees can cost you thousands over the years. Here's an example. Say you invest $10,000 in a mutual fund with a 2% annual fee. It sounds tiny, but over 20 years, those fees could cost you nearly $10,000, money that could have compounded if you'd invested elsewhere. It's one of the wealth secrets investors don't want you to know, because those fees keep investors dependent on traditional financial institutions without realizing the cost. How can you avoid this trap? First, always check the expense ratio before investing in any fund. The lower the ratio, the less you're paying. Aim for funds with expense ratios under 0.5%. Index funds and ETFs are often good options. These funds mirror the market, minimizing both risk and fees. Also, look out for platforms that allow you to trade without brokerage fees, especially if you're just starting. Finally, diversify across low-cost funds. You don't have to stick to one investment type. Consider mixing in ETFs that track broad indexes, or even low-fee robo-advisors that can provide diversified portfolios with minimal fees. Avoiding hidden costs means more of your money stays in your pocket, allowing it to grow and compound over time. Remember, even a small reduction in fees can translate into thousands of dollars over the years. Staying vigilant about fees puts you ahead of most investors, allowing you to grow your wealth without silent fees quietly diminishing your returns. All right, here's a tough pill to swallow. Not every smart financial move is actually smart. In fact, some popular strategies can lead to serious wealth loss. Remember the dot-com bubble of the late 90s? It was all the rage, and smart investors were throwing money at any company with a dot-com in its name. But when the bubble burst, people lost fortunes overnight. The lesson? Not all high-growth investments pay off, and not every strategy is foolproof. Sometimes, strategies that appear promising on the surface come with hidden risks that can wipe out wealth faster than it was built. Leverage is another classic example. When you borrow money to invest in a sure thing, you double your potential gains. But here's the catch. Leverage doubles your potential losses too. It's like playing with fire. High reward, but if it backfires, it's brutal. Leverage can work for seasoned investors who understand risk deeply, but if you're new to the game, it can easily become a wealth trap. Here's one of the wealth secrets investors don't want you to know. Because many investors are encouraged to borrow, thinking it's a smart move. In reality, leverage often benefits banks and lenders more than investors, especially during market downturns. Now, take a look at real estate investors who leveraged heavily in the 2008 housing crisis. They borrowed to buy properties expecting prices to keep rising. But when the market collapsed, those investments turned into crushing debt burdens. Knowing when to use leverage and how much risk to take on is essential. So, how do you avoid these traps? First, focus on balance. Don't put all your eggs in one basket, and always ask yourself, how much could I lose? It's tempting to go big, but remember that slow and steady growth is often the most secure path. Instead of chasing high-risk gains, look for stable, growing industries with a proven track record, like healthcare, consumer staples, or utility stocks. These sectors provide consistent returns with less volatility. Diversify across assets and industries and build your wealth on a foundation of stability, not just high stakes. Let's dive into a part of wealth building most people underestimate: mindset. It sounds basic, but having the right mindset can make or break your success with money. Warren Buffett, for example, didn't get rich by chasing the next big thing. He became wealthy by sticking to a long-term strategy and developing patience, discipline, and adaptability. And these are the qualities that matter more than any stock tip. Patience is one of the hardest traits to cultivate in a fast-paced world. We want results immediately, right? But the ultra-wealthy know that great wealth isn't built overnight, it's a process. Patience allows you to stick with your investments through the ups and downs without panic selling when things get rough. Then, there's discipline. This is the ability to avoid jumping ship every time a hot stock comes along. It keeps you focused on your long-term plan rather than short-term gains. Finally, adaptability. Markets change, and so should your strategy. The 2019 situation proved this when traditional retail stocks plummeted while tech and digital companies surged. If you're adaptable, you can adjust your investments based on new trends without missing a beat. So how do you develop these traits? Start by setting clear financial goals and tracking your progress. If you're saving for retirement, avoid checking your account daily. This helps you build patience and avoid emotional reactions. Discipline can come from automating your investments, set up regular contributions, and don't touch them. And as for adaptability, stay informed. Read financial news, attend workshops, and stay curious about the economy. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Now let's talk diversification. You've probably heard, don't put all your eggs in one basket. But diversification is more nuanced than just splitting your money between stocks and bonds. In 2020, for example, the pandemic crushed traditional stocks, while non-traditional investments like cryptocurrency and gold soared. Investors who diversified saw gains, while others suffered losses. And this is one of the wealth secrets investors don't want you to know. So what can you do? First, look into alternative assets beyond stocks like real estate, peer-to-peer lending, or REITs, real estate investment trusts. These are relatively low-cost, stable options that aren't directly affected by the stock market's ups and downs. Or consider precious metals like gold and silver. They tend to perform well during economic downturns and act as a hedge against inflation. Another option? Diversify within the traditional investment world. Instead of putting all your stock money into tech, spread it across industries like healthcare, renewable energy, and finance. If one sector struggles, others can still perform well. The takeaway? Diversify beyond just stocks and bonds. Adding alternative assets can help cushion your investments when the market hits rough patches. And always remember, a balanced, diversified portfolio has the potential to weather any storm. This next one's big: the influence of global economics on your wealth. We're living in a world where changes abroad can impact your finances at home. Think about Brexit. This one event in the UK caused global currency shifts, stock market swings, and economic instability across Europe and beyond. Even if you had zero investments in Europe, you felt the ripple effects. With the recent US election, some might feel disappointment or uncertainty about the future. But instead of focusing on the emotional reaction, let's look at how to follow the money and find ways to create wealth in this situation. Each administration tends to bring its own economic focus. Some favor green energy, others traditional industries. Some prioritize tech, while others lean into infrastructure. The key is understanding where money will flow under the new leadership and positioning yourself to benefit. For example, if the new administration supports green energy policies, this could mean an increase in funding and incentives for renewable energy companies. Investing in companies within this sector, such as solar, wind, or electric vehicles, could lead to significant gains over the coming years. Similarly, if the administration focuses on upgrading infrastructure, companies involved in construction, materials, and transportation could see an uptick in business. Emerging markets are another example of where you can benefit. Countries like China, India, and Brazil are growing rapidly, and their demand for commodities affects prices worldwide. Investing in ETFs or funds with exposure to these markets can help diversify your portfolio and capitalize on their growth. This is one of the wealth secrets investors don't want you to know. Because if you understand global shifts, you can anticipate market trends and invest strategically. To apply this, stay informed on international and political changes, especially on trade policies, energy initiatives, and geopolitical shifts. Even a modest investment in sectors tied to these changes can yield returns. Consider diversifying into international funds or ETFs that invest in emerging markets. That way, when these economies and policies grow, so does your portfolio. Let's talk scaling up. Many of us start with small investments, but the key to building wealth is knowing how to grow those investments over time. Consider the story of Chris, a teacher who started investing $100 a month. He didn't have much, but he consistently invested in an index fund, reinvesting every return. Over 15 years, his $100 grew into tens of thousands of dollars, all thanks to the power of compounding. Now, let's look at the flip side. Imagine Sarah, who also started with $100 a month. But instead of investing consistently, she kept jumping between investments, chasing hot stocks and trends. She'd see something trending and pull her money out of one investment to put it in another. Because she never allowed her investments time to grow, she missed out on compounding. By the time Sarah hit 15 years, her portfolio had only grown to a fraction of Chris's. This contrast highlights one of the wealth secrets investors don't want you to know. Consistency beats quick wins. In Sarah's case, the constant changes ate into her returns due to transaction fees, and her investments didn't have the stability or time to grow. Here's how you can apply Chris's strategy and avoid Sarah's pitfall. Start by setting a monthly investment amount, even if it's small, and commit to it long term. Choose assets with growth potential, like growth stocks or ETFs, and reinvest any gains. Also, consider dividend stocks. They pay you regularly, which lets you buy more shares without needing extra capital. Avoid constantly shifting investments based on trends. Instead, focus on steady growth. With patience and consistency, small actions now will lead to big results later. Now let's talk legacy. When most people think about wealth, they think of enjoying it during their lifetime. But true wealth goes beyond personal gain. It's about creating a legacy that benefits future generations. Take John D. Rockefeller, for instance. He didn't just accumulate wealth. He carefully planned how to preserve it for his family. He established trusts and passed down not just money, but the knowledge of how to manage it. So, how do you build a legacy? Start with long-term assets. Real estate, for example, is a classic choice because it tends to appreciate over time and can generate passive income. But there's more. Setting up a trust fund can help shield assets from hefty estate taxes, ensuring that your wealth remains in the family. Another critical piece is education. Teaching your family about financial literacy is as valuable as leaving them money. If they understand how to manage investments, they'll be able to grow what you leave behind instead of spending it all at once. This is one of the wealth secrets investors don't want you to know. Because the wealthy know it's not just about leaving money, but also about equipping heirs to preserve and grow it. To start building your legacy, identify assets that align with long-term goals. Consult a financial advisor to explore trust options and tax strategies. And perhaps most importantly, start a conversation with your family about wealth management so your legacy endures beyond your lifetime. Now let's dive into a timeless debate: time versus money. Many people chase money, but the ultra-wealthy understand that time is the true asset. Jeff Bezos, for instance, reinvested every dollar back into Amazon for years, focusing on growth over immediate profits. By prioritizing time, he built one of the world's most valuable companies. This principle is one of the wealth secrets investors don't want you to know, because most of us are told to work harder to earn more, but the wealthy think differently. They leverage time as a multiplier. Instead of trading hours for income, they make decisions that allow their money to work for them over the long haul. This difference in approach is what separates incremental gains from transformative wealth. So, How can you maximize both time and money for long-term wealth? Start by investing early. If you're in your 20s or 30s, even small investments can grow exponentially due to the power of compounding. Compounding is like giving your investments a turbo boost, where even modest returns snowball into substantial wealth over decades. If you're older, you can still maximize time by focusing on assets with quicker returns, like high-yield bonds or dividend stocks that offer regular payouts. Additionally, build passive income streams. Investments like real estate rentals, dividend-paying stocks, or even automated side businesses can generate consistent income without requiring constant effort, effectively freeing up your time. Another smart move is to set up automatic investments so you don't need to micromanage your finances. By balancing time and investment wisely, you're setting yourself up for a future where you don't have to choose between wealth and freedom. You have both. Let's talk about the dream earning while you sleep. Passive income is the ultimate financial goal because it allows you to earn money without constant effort. Think about Sarah, who bought a small rental property a few years ago. Now, the rental income she receives covers her monthly expenses, giving her financial freedom. This is one of the wealth secrets investors don't want you to know. Because passive income is the key to independence, yet most people are never shown how to build it. So how can you start? Begin with small, manageable options. For example, if real estate sounds daunting, consider investing in a REIT. These real estate investment trusts allow you to invest in property without the hassle of being a landlord. Or look into dividend stocks. By investing in companies that pay dividends, you earn a regular income from your investments. Another option is creating digital products like ebooks or online courses, which can continue selling long after they're created. The secret to passive income is to set up one stream at a time and keep expanding. As each income source grows, reinvest a portion to create additional income streams. Over time, you'll have multiple sources of income working for you, giving you both financial stability and peace of mind. Finally, let's talk about staying ahead of the curve. Think about how Apple revolutionized tech with the iPhone. Investors who saw this trend early and bought shares witnessed massive gains as Apple grew. Those who understand trends don't just ride waves, they create wealth by positioning themselves ahead of them. Keeping up with trends is one of the wealth secrets investors don't want you to know. Because it's not just about following the crowd, but about spotting opportunities before they become mainstream. This approach requires both innovation and awareness of emerging fields like AI, green energy, and blockchain. These aren't just buzzwords, they're shaping the future economy. So how can you apply this? Start by staying informed. Read up on emerging technologies and track companies leading these fields. Diversify a portion of your portfolio into these industries, but do so cautiously. Allocate only what you can afford to risk, as trends can be volatile. And remember, trend-based investing isn't about betting on every new thing. It's about finding and investing in areas where you see true long-term growth. The key to wealth building isn't just making the right moves, it's making them at the right time. When you're willing to innovate and look ahead, you're setting yourself up to stay one step ahead. And there you have it. The wealth secrets investors don't want you to know. These principles aren't just about chasing quick gains, they're about building a solid foundation for a secure financial future. The strategies we covered, from avoiding hidden costs to creating lasting passive income, aren't overnight fixes, but long-term moves that can reshape your financial life. Whether your focus is avoiding unnecessary fees, navigating global market changes, or building a financial legacy, these methods empower you to make smarter, more informed decisions that build wealth over time. Each of these secrets gives you a competitive edge, helping you stay ahead in a way that aligns with your goals and dreams. As we conclude, it's important to note that this video is meant to educate you on the various aspects of investing, not to provide specific investment advice. Investing involves risks, and you should always do your own research and consult with professionals before making any financial decisions. Past performance doesn't guarantee future results, so always consider the risks involved. If you found this video helpful, I highly recommend checking out my next video, which complements this one perfectly. Don't hesitate to share this video. It might help someone else too. Please subscribe to the channel and share your thoughts on today's content. Thanks for watching. And remember, financial freedom isn't just a destination. It's a journey that starts with knowledge, action, and consistency. Until next time, keep building, keep growing, and let's make financial freedom a reality together.